I like to talk about cash flow a little bit because I think it's often made out that it's the only fruit in property. A lot of property strategies are around generating cash in the now. We forget a number of things. Number one, pre-2008, there weren't many magnificent cash flow strategies. People did HMO before the term was coined. People did serviced accommodation before we called it serviced accommodation. But lots of property investors bought a property and actually put money into it every month, like a real sort of traditional pension style approach. So the whole cash flow thing has only really come about since the days of the ultra low interest rates following the 2008 crash. And it's always important because it's important in any business, but it's not the only fruit. I've run a whole number of long-term planning scenarios over 10 and 15 years based around building property portfolios based around single lets. Really boring. Hardly anybody says they want to do it these days, but still eminently doable and profitable. And what those scenarios show me is if I can buy intelligently, if I can buy genuinely discounted property, when I get to the end of my 10 or 15 year horizon, about roughly a third of my profit has come from buying well. Roughly a third of my profit has come from the rents that I've gained in the here and now and the cash flow side of it. And roughly a third of it has come from capital growth. So cash flow is important, but it's a third of where the real money is at the end of the day. And people often say, the cash flow in the now is what keeps the business going. The real wealth is built by being able to, as again Warren Buffett would say, sit on your hands over time, not necessarily dipping in and out and doing 5 million things, and not chasing shiny pennies, as Karen correctly said. So